Hello, everyone. My name is Jacob Fortum. I'm the host of this podcast, Doers Within Emerging Markets. And I just want to share my experience with using Anchor so far. So when the pandemic started, I thought about starting a podcast. And the whole idea was to bring in some really amazing folks that are doing some great work in their respective industries within the emerging markets. And the Anchor platform really helped me get the word out there and also just make it a lot easier for me to invite the guest and just share the amazing experiences they've had and the amazing work they're doing in their respective industries within the emerging markets. So it's pretty fun. You don't even worry about the technical part of making a podcast. You actually just focus more on the content. And Anchor has done it really well for me. So I will highly encourage anybody who is trying to start a podcast to try to use just check out Anchor, and I think you won't regret it. I'm not a technical person, but if you listen to these episodes that I've been publishing so far, it seems like I know what the technical part of it, but Anchor helps you take care of the technical part, and you just focus on the content. So feel free to check it out. I highly encourage you. Won't regret it, and it's right there. You don't pay anything, so. In times like this, I think starting a podcast and getting the word out there, irrespective of what you're doing, will be a really great experience. So thank you guys for listening to my episodes. Please check out Anchor and you will have a great time. So cheers, guys, and see you guys next episode. Thanks.
About microfinance not just being a business model for developing countries, and I started by giving examples of microfinance companies that are operating here in the United States. I gave an example of Cabbage. Cabbage, which is spelled with a K, K-A-B-B-A-G-E. You can check them out later after this call, or you can do it as I speak. So they do provide credit to small and medium-sized enterprises. A lot of it started as a way of factoring receivables. So like when companies have outstanding payments from the clients and they need cash flows to keep paying for supplies from the creditors, companies like Cabbage would provide that. So they are basically very fintech in the sense that they leverage a lot of technology, which makes it the business model a lot bit different from most microfinance companies in developing countries. And I will come back to describing how these business models work. Another one that you might want to look at is Autobooks. Autobooks is also doing receivables financing. The platform is also very tech complex. They use a lot of algorithms that capture credit profiles of the founders of these companies as well as the cash flows, and there is a way they credit score these companies on that basis. You can also look up Tab Bank, TAB. It's a purely digital bank, and it's been here in the US for over 20 years, providing credit but without any bank branch. So I thought that would be a very exciting example to talk about. But back to the traditional microfinance model, started off the whole concept, I think we all know, might have heard of, started off or was formalized in Bangladesh by the father of microfinance, one Professor Muhammad Yunus. And he was a professor working in kind of a very not so urban university, and he started by piloting, giving out loans to low-income women in the geography where he was lecturing, and realized that women were actually very disciplined repayers of loans, and that it was sustainable to actually lend to low-income women and do it profitably, because they were repaying in good time and they were paying well enough with enough margins. And so that concept replicated across different geographies and was formalized into what is currently called Grameen Bank, with operations in Bangladesh. I'm not sure which other countries in Asia it has expanded to, but Grameen is also headquartered in Washington, D.C. right now, being the think tank of microfinance and sharing a lot of success stories and best practices around microfinance. There are a lot of other institutions of that kind that are not for profit, that do a lot of research and technical assistance to microfinance institutions across the world. And they include, the Gates Foundation, International Finance Corporation, we have Axion, or Media Networks, and so many other non-development finance institutions. The IFC, Women's World Banking, you can think of as many as you can. I would stop there. I'll pause, and if anyone has.
So Duncan, can you please help me clarify? So I know cabbage is mostly predominant in the US, right?
Mm-hmm.
So have they extended beyond the US? Is that what you mentioned? Because I thought they were just local, US local based.
Yeah, they have not extended outside of the US to my knowledge, but I was giving examples of microfinance companies that are operating in developed countries. I think, like I said, there is a huge assumption that microfinance is a business model for low income or poor countries, but that is really not the case.
That makes sense. Thanks.
Yeah, so companies like Cabbage, they provide credit to businesses that have around 10 to 12 days of cash on hand. And so really, like we know, cash is king for most small and medium-sized businesses. And so their business model is around helping these businesses keep cash at their doors, and especially in harsh economic times like this. But there are also a lot of fees that are associated with the lending to small-sized businesses, which is something microfinance is criticized for, but we shall come to that. I think about 2 weeks ago, there was a circular that went out around about cabbage. Yeah, so I stopped at talking about some of the development finance institutions that are providing either technical assistance to microfinance institutions around how to develop products or go-to-market strategies, and sometimes around just serving low-income women, because the business model around microfinance kind of similar to banks, but not really the same in many aspects. And so I have talked about a few of them. One other that I wanted to mention is called SIGAP. SIGAP stands for Consultative Group to Assist the Poor. It's a consulting firm that's a spin-off from the World Bank. It's actually housed and founded by the World Bank. They're based in Washington, D.C. And they do a lot of publications, webinars, and subsidized or free consulting services to microfinance institutions that are providing services to some of the poorest people across the world. And then they also release their information webinars and even jobs and a lot of research findings around microfinance through a platform called the Microfinance Gateway. It's a very interactive and knowledge sharing platform that would be good to look into. And a lot of the audience are broadly players in the financial inclusion arena. I cannot think of any other player in the development finance institution space. I think I've talked a lot about all of them. But on the consulting side, you want to think of SIGAP and sometimes another firm also called MicroSave. It started out of Uganda as a microfinance development facility and then grew out into a big brand. It's based out of Nairobi in Kenya. They have offices in Latin America and in India as well. And it's considered a thought leader in the space of financial services for the poor, heavily funded again by the Gates Foundation and many other development finance institutions. I worked for MicroSave as a consultant in Kenya, and we did a lot of projects across sub-Saharan Africa and Asia as well. Yeah, so that leads me to, I think I've spoken about the assumptions around the business model of microfinance, and I think there's some clarity around that. I'm happy to answer any questions, but I also wanted to talk about how did microfinance become a business model that just survives, or very well, alternatively you can say it does very well in low-income countries, and despite being there for almost 50 years now, it has not changed many lives. There are a lot of school of thoughts around it, but the way microfinance is designed, it does not really end poverty. In many cases, microfinance loans actually leave the borrowers more impoverished than they were, but that's not the case in all instances. First is because the challenge around microfinance has been relatively higher than normal interest rates, charging between sometimes 0 up to 50% or even 100 and more. One thing about microfinance is a lot of them started off as, being heavily funded by NGOs and being non-profits, just giving out money to low-income women or men or business models of that kind, and then grew out into charging small amounts of interest. But because of the risks associated with the borrowers in microfinance, a lot of them do not have collateral that banks look for when lending, and they also do not have a credit history against which the banks should lend. So the assumption is they are kind of a very risky market. And so that's why the interest rate is pretty high. But the other assumption that I wanted to make clear is the interest rate is high because it's not a lot of money. So microfinance borrowers borrow sometimes $100, $50, or even 20, which is not much. And so when you charge a 25% interest on that money, it's not a lot when you compare to the costs that are involved in giving out that loan. And then these costs include having to send a field officer to meet these groups of women. And that brings me to the topic of how does microfinance work? And so I just wanted to bring that out. So how it works is, one, we have different models of microfinance, but the most predominant one is group lending. And so group lending involves loaning money to a group of people, usually in the same geography, sometimes in the same market, in rural areas or in peri-urban areas, and sometimes in the urban areas as well. Usually they know each other, they meet regularly, they have savings that are rotating among the group members. And so when you loan to them, this is how it works. Every member of the group has to has to sign off that they have approved that one of their own is supposed to receive a loan. And in case of default in repayment, each one of them then contributes and repays on behalf of the defaulter. So for example, a group of 8 people meeting in a week, one of them has a loan to pay, or at the same time, every week they meet, they do have some savings that they contribute. A portion of that saving goes to their pool, a pool of, shared pool of money that they own as a group, which they don't touch. They only use that for emergency. But also a significant portion is given to one member of the group, and the next week it's given to the next person, and the cycle continues. So in case one of the 8 members is not able to repay a loan in that particular week, these other 7 people contribute each and then pay on behalf of that 8th person. So it really, really helps in terms of managing default, but also because these people are in the same geography, they know each other, they usually already can preempt when one of them is not going to make it for that week or for that month. Actually, loans are paid every month, but the savings are pulled every week. Um, and so the banks usually have field officers who go to the field and meet with these groups, explain or sell their products that the bank has or the microfinance institution has, and then also monitors the repayment of these loans. Do we have any question up to that point?
So I have a question, please. So based on the group lending, was it a controlled test that was allocated to show the efficacy, or just like to show that that was the most appropriate way to reduce default and increase, the economic outcome of the process? Was it just by intuition, or was it something that, based on experience, was it something by intuition, or was it based on like a scientific study or social study, that was done to showcase that group lending was the right approach?
Yes, I think that's a good question. I would say that there was already group lending or group savings in many geographies in the world. And sometimes it was not just in a formalized way. So the easiest way to roll out the test, the test that Professor Yunus did, was to work around these informal groups. And so lending to these informal groups became a lot easier. First, because they already exist, they have very strong bonds that no one can take away from them. And the easiest way is to tap into these existing bonds if you want to be successful in that element. And so yes, it was already existing, and the control test just served to prove that, to validate the group lending model that was already existing. In many formal setups, even in geographies where there are no microfinance companies to date, you will still find locals either saved together. We have seen people or women just contribute and buy a cow together. They own the cow, and then one of the members of the group keeps the cow in the home, but it's co-owned by members of the village. And so when they sell milk, they do sell it, but the money belongs to a group. So such kind of informal savings were already existing, but the only challenge was they were not getting any loan, even though such kind of informal setups and projects are already generating cash flows. So that's something that Yunus took advantage of.
That makes sense. Thank you.
Dancan, I had a quick question about the model, if that's okay. This is a little specific, but you had mentioned savings were made on a weekly basis. Oh no, lending was made on a weekly basis, but repayment was on a monthly basis. Did I get that right?
No, so actually lending was done on a monthly basis. So two clarifications here. So we do have the groups that have weekly meetings. They just meet and contribute savings among them. Sometimes the institutions join them to provide trainings on financial literacy or business development and many other aspects for microfinance companies that do just beyond lending. But that's another story. So just like any other bank loan, the loans that once given are repaid every month. And so in one of these weekly meetings, one of them is usually a loan payment day. And so they meet just as they would for every week to collect their savings, but on that particular day, on top of collecting their savings, they also collect loan repayments.
That happens in the month. And then on that same day or at that same rate, someone also gets to borrow once a month. Is that once a month, not once a week?
Yeah, someone also borrows once a month. But one clarification, not everyone in the group is compelled to borrow. You only borrow when you need money. And so not everyone in the group has an outstanding loan at any one point. Sometimes in a group of 8, only 1 or 2 might have a loan, maybe because they need it. but sometimes others are just members of these groups that are in the circle or recognized by this microfinance institution, but they don't have any outstanding loan.
Thank you.